When you invest in your superannuation, do you actually know what you own? Not just the name of the fund manager, but the individual assets that are inside. Because for most people, the answer is no. And that's where this conversation starts. Most portfolios are built using managed funds or ETFs. They're pretty simple, they're accessible, and for many people, they do the job. But as portfolios grow, the limitations of those structures can become more noticeable. Less visibility, less control, and outcomes that aren't always aligned to the individual. There's another approach worth noting. It's called a separately managed account, or SMAs. So what exactly is an SMA? At its core, it's a professionally managed investment portfolio, but unlike traditional managed funds, you retain the beneficial ownership of the underlying assets. This means the shares, ETFs, or securities are held in your name, not pooled and not blended with other investors. Individually owned. So how does this differ to what you have in a traditional super fund? In a traditional superannuation fund, without access to SMAs, investors contribute into a single pool of capital. Decisions are made at the fund level, and every investor shares the same outcome. With an SMA though, the same professional strategy is applied, but within your own account. So while the management is centralized, the ownership remains at your level. That distinction is important. So what are some advantages to having an SMA? There are a few practical advantages to this structure. First, I would say is transparency. You can see exactly what you hold down to each individual investment. Second, control and flexibility. Portfolios can be aligned more closely to your preference, tax position, and objectives, rather than fitting into a broad, standardized approach. Third would be the tax efficiency. Because assets are owned individually, your tax position is not influenced by the activity of other investors in the pooled fund. And all the attached franking credits, important tax offsets to note, attached to your investments are broken down and easily trackable. And finally, professional management. Investment decisions are still handled by an experienced portfolio manager. Whereas before, if you wanted to have access to directly owning shares, which is what an SMA gives you access to, you would have to rely on your expertise. This is why most people jump into the managed fund section, because they wanted a portfolio fund manager. But this sort of sits in the middle where you still have the direct ownership, but get access to a professional fund manager. So again, still handled by an experienced portfolio manager using structured strategies and not just guesswork. If you want to visualize it, simply a managed fund being the typical investment choice in most super funds looks like a single pool with many investors owning units within it. Whereas an SMA structure shows individual investors each holding their own set of underlying assets. One is collective ownership and the other is direct ownership. The SMA is pretty passive in its nature. You still have that fund manager looking after everything, so you don't have to be worried about whether you need to actively be doing anything extra. It's still a sort of an asset class where it can just do its own thing, versus direct equity investing, you kind of have to have a bit more expertise and be a bit more hands-on. So this is why people love SMAs as well, because it is still that sort of in the background nature. So who may this suit in terms of a asset class? Tends to suit investors who want greater visibility over the portfolio, prefer a more tailored investment approach, and are increasingly focused on tax efficiency and control, particularly as their portfolio size grows. In terms of access, SMAs are only available through specific wrap super funds, not your traditional super funds being a master trust, which is pretty much where most people sit. But there are plenty of wrap providers out there. You do probably need an advisor to sort of give you that hand holding. But there is plenty of options out there, and you can get access to SMAs within most wrap super funds. To gain access to a wrap super fund, though, you do need an advisor in most instances. But having said that, it is pretty accessible to pretty much all super fund members. You do need sort of minimum amount of balance, usually $20,000, $30,000 to put into that inside your super. But for most people, their super balances are quite high, so they can gain access to that asset class. So if you want to find out a little bit more about whether this suits you, what it means to have an SMA within your portfolio, and get a bit more of an understanding in relation to your super position, there's a link at the bottom. It's a free 30-minute video strategy session, and we will go through all your options as a complimentary service.